Markets are continuing to decline today as they absorb more of the higher for longer and tough hawkish speak from Chair Powell yesterday, as he continues to answer questions and testify to Congress and the media and everybody about what is going on, what they are seeing. The Dow down about 0.5%, S&P down 1%, NASDAQ down 1.71%. And stocks are falling again as the Fed dashes hopes for a softer interest rate policy. Somehow their press release was interpreted as dovish, but as we know, he came out extremely hawkish. The post-Fed hangover continues to keep pressure on U.S. stocks as the impact from the first round of hikes is finally beginning to be felt. And the big thing that we have on deck this week is we have the jobs coming out on Friday. And then next week, we have the inflation report. And inflation's probably going to continue to come in hot, potentially higher than last month, because this is October's inflation report coming out in November. The Fed doesn't meet again until December. So there won't be too much damage in the markets on the news unless inflation is just extremely high. Now, if it comes in lower, then the markets will have a nice little bounce and a nice little surge. But I think we're going to continue to see a little bit of leakage in the markets, slippage in the markets, decline in price of the markets ahead of that CPI, because all indications are it's going to come in probably equal to or higher than it did last month. As we all know, there has been no easing of inflation. I know some of the incumbents and administration wants everybody to believe that inflation has come down and all of these things, but we all know that prices are high. They've remained high. Rents are continuing to increase. And what the Fed and Chair Powell spoke about rents a little bit. We'll talk about the housing market here in a minute. But he acknowledged that when you look at in-place rents, that's one thing. When you look at renewals, that's a whole nother ball game. And anybody and everybody can tell you that their rent is going up every time they renew their lease. So there's no decline in rents like is being reported, at scale. Some markets here or there, but there are no declines in rents for renewals unless they're just uncompetitive, outdated properties in tougher markets and people are moving because the rents are way too high and they're coming down maybe a little bit from exorbitant levels, distorted levels, just like everything else, as the bubble has popped in markets, real estate, rentals, all kinds of things. So tough times out there right now. Let's take a look at the market. It's not too bad today, down just a little bit. Dow's kind of bouncing back a little bit today. But again, the key level to watch on the Dow is going to be that 28.7 to see if price will come down and break that. Now, October low, NASDAQ working its way down to that October low, see if it can take that out. S&P, it's not quite there yet. So most likely we'll take these lows out, set a new low, and then maybe the market can start to put a base in there depending on what's going on. As we get into earnings, end of the year earnings and things like that, and projections into 2023. VIX is down again today, which is surprising a lot of people. But again, you get to this 19, 20, 22 level area, that's definitely, when you got to watch out. When the VIX is low, look out below. When the VIX is high, it's time to buy. So VIX is marching its way down. The Dixie has a little bit of a comeback today, getting ready to push back to that, towards that 115, 114, 115 level. The 10-year was marching up a little bit today, found a little bit of resistance. We'll see if it can break that 4.3% level. And this is the biggest issue for the markets right now, is the 10-year. Let's take a look at bonds here real quick. If you take a look at that 10-year and more specifically the 2-year, this is what's causing so many problems for the market. I mean, the 2-year hit 5% today. So when you have rates at that level, it just doesn't make any sense to take any risk in real estate, to take any risk in equities or anything like that when you can park money and get a 5% yield. This is where big money can go. Investment funds, sovereign debt funds, wealth funds, and even just individual investors that have cash on the sideline. Why deploy it into risk assets when you can get a guaranteed return over 2 years, ride out this inflation, recession, things like that. So risk-off environment, risk on, was back here. Leading up to this has been why the markets have declined this year, is the climb in treasuries. So those are the things you want to pay attention to. Bitcoin kind of still hanging on. So obviously the levels for Bitcoin to watch really is this 18,457 level. That's your key level for Bitcoin. Ethereum kind of hanging on. And here's XRP, Cardano, Litecoin had a little bit of a bounce, getting a lot of people excited there. Just capital rotating around. And we will have to wait and see if there's going to be continued downside. Here's Dogecoin. It's kind of hanging on to this 12.5 cent level here, popping up and down. Nice price action in Dogecoin there, based off of the Elon buying Twitter narrative, and who knows what they thought that meant would be for Dogecoin. I don't know, but anyways, a lot of speculation going on in the markets. But the biggest issue is too much yield in treasuries, especially when you're comparing it to real estate. And on that note, let's talk about the housing market a little bit. Continuing its decline with rates above 7%. The market is really starting to correct in most areas. And this time of the year, most people pull houses off the market going into the holidays. So our inventory levels are still low. There's still not a whole lot of inventory out there in a lot of markets. Every market's different. Some have more than others. The builders are still running into trouble, facing a lot of cancellations. There's news out today that in Phoenix, they have a 70% rate of cancellation of new construction homes that were under contract, people canceling those contracts. So we're seeing that all across the country. Just because rates are high, they can't qualify on certain product, and people don't want to buy a house in a declining market when values are correcting and adjusting, albeit coming down again from very high distorted bubble levels, but still prices are coming down. The wealthier high-end buyers that are buying cash, are still out there, and we're still competing for houses in certain markets. But even that segment now is going to pull back because of price declination. And when appraisers have to note on the appraisal that you're in a declining market, that kind of puts pause even for cash buyers, even for wealthier buyers. But like I said, you're going to see the housing market correction show up first with the new home builders. They have the ability to cut prices the quickest. Then you have your resort markets, where some sellers might come under pressure that are over leveraged if they had interest-only debt on vacation rentals. So you might see some of those come on the market, but there's not enough of those out there that are stressed to really affect inventory levels and create an oversupply. Some markets might, but not most markets around the country. And then the housing recession in general. I put a tweet out the other day, and somebody asked a question that in the housing recession, isn't it the trades contractors and hourly workers that get hit first and get laid off first? No, the housing recession, the first people that get laid off and the first people that are affected are the mortgage lenders, the realtors, title companies, closing attorneys, all of the professional services around a real estate transaction is who gets affected first, because that's what stops first, is transactions just kind of stop. So all of that, all those jobs, all of the money that's pumped to the economy from that end of the spectrum gets cut and hit first. The builders are still finishing. So there's a lot of builders that are still finishing a lot of things. Some builders aren't starting new projects, but a lot of the builders had stuff in the pipeline, so they've got to finish those out through the end of the year. Everybody I'm talking to, my clients around the world or around the country, well, around the world, I do have some builders internationally in other countries that are building. Their markets are very different, but the United States is the one that's affected the most right now in construction. Most of the builders are waiting to see what things look like going into next year before they do any layoffs, especially with the holidays coming, things like that. So we're continuing to see a lot of pressure on the housing market. Financial markets are trying to work their way towards a test of the October lows and try to put in a base there. We can expect inflation to come in hot. We can expect the job reports to come in strong and continue to bolster the case for the Fed to continue the tightening. The big thing is the Fed funds rate is now targeted above 5%. It's going to have to stay there into next year before the Fed can start slowing down and pausing. And if they do pause, it's going to stay up for quite some time, because inflation is way more sticky and stubborn than they ever anticipated. And the only way to get it down is to destroy demand. How do you destroy demand? you take the money out of the hands of the buyers and the spenders. So those are the things I'm looking at. I'll see you